All right, so what we believe that today will also be another very interesting section. We'll be looking at company income tax or companies income tax, whichever way you want to look at it. All right, so I believe everyone ready. Please, if you are, please type ready on the chat box, please. If you are there and you're very much ready for this session, Khadija, you are cited. Adeyemi, Damilola, Salau, okay, John. All right, that's good. So let's go on. So today we'll be looking at company income tax, and as much as possible, we don't just want to have all this talk and not see any professional impact on what we have been discussing thus far. So on that premise, on what we have done thus far, I've not seen anybody engage the platform or send messages except a couple of few people on how you've been able to apply what you've learned thus far to your work. For those who are working already, it is our expectation that you corroborate what you have learned here with how you can be a better performer in your various places of work. So should you have any concern, please don't feel shy. We are all learning. So feel free to communicate directly. Somebody sent an update or a request for clarification yesterday, and I'm sure that has been well addressed. Beyond the time for all this training, as much as possible, we pray that God will continue to spare our lives. We want to sustain that learning relationship where we can reach out to each other on areas of clarifications, on areas of concern. And trust me, as a firm, and for me, will be very much available. So today we'll be looking at introduction to company income tax. Why do we have to do company income tax? What relevance company income tax to business process? What actually informs it? Is it a legal requirement? Does it have a legal backing? We'll get into learning that today. Then we'll look at also who among the various business entities are liable to company income tax. Maybe I should even start with that. Which categories of companies are liable to company income tax and which is not? Which categories of business entity, let me put it that way. Bear it in mind that we have, when you want to have a business formally registered, you can have it as what we call is sole proprietorship. You can have it as a registered business name for partnership business, and you can have it incorporated as a legal independent entity. Who among these categories of people is liable to company income tax and which is not? Okay, Adia said limited liability, limited companies are liable to company income tax. What about the sole proprietorship? How are they taxed? Khadija say it is incorporated legal entities, okay. John says all except sole proprietorship. What about partnership? John, are they liable to company income tax? Okay, Adia says, sole proprietors pay personal income tax. Okay. Khadija said, sole proprietorship is liable to personal income tax. Okay, so let's go on. Let's go on. So we'll be looking at those categories of entities that are actually liable to such form of taxes. Then we look at differences between accounting profits and tax profits. We look at what you could be interpreted as allowable expenditures and disallowable expenditures. What makes them allowable? What makes them disallowable? What makes them, how do we identify when an expenses or expenditure is an allowable? Is it just by virtue of our personal judgment, or we make reference to a substantive legal provisions? So we learn that also today. Emeka, you are well cited. Limited liability companies pay CIT. Thank you. Okay, so we look at that today. Then we look at what we call the waivers and refunds. We look at non-taxable income, section 23 of the Company Income Tax Act, addresses some areas of profits that are not, that are exempt. The interest deductibility, we'll be looking at that too. We look at interest that arose from loans that are obtained within the country and foreign loans. What exceptions are applicable before 2019 Finance Act, and what exceptions are applicable after 2019 Finance Act. There is also something similar to this, which we call thin capitalization. Who has an idea of what thin capitalization is? Thin capitalization, thin is THIN. When you say a company is thinly capitalized, what does it mean? More of debt compared to equity. Fantastic, Odemi. That's a very good contribution. So we'll be talking about whether Nigeria has a thin capitalization policy prior to 2019, and what is the substantive provisioning after 2019. Or does anybody have an idea? What is the thin capitalization policy after 2019, or based on 2019 Finance Act? Danjuma, it does not mean that debt capital is more than equity capital. It's just looking at the comparison between debt capital and the equity contributions. But thank you for your contribution. It's well appreciated. What is thin capitalization policy? I believe no one is going online to check in this. Don't go online to check this, please. Let us just have your view. If you are wrong, you won't be crucified. What is the thin capitalization policy in Nigeria, effective 2019 Finance Act? Any contribution? Any contribution? Okay, I'm not getting any feedback from anyone. Okay, we'll talk about it as we go on too. Okay, no problem. Just make sure that if I didn't mention anything about it towards the end of this class, bring me to remembrance. So we talk about thin capitalization policy effective in Nigeria, effective 2019 Finance Act. Then we look at the basic computation of company income tax. A lot of people, particularly those who are in practice, will have a good understanding of this and how it works. And how it works. But for the benefit of those who don't have such, at the end of this section, we would even not only just deliberate about it, but we share a template that you can use in making sort of that computations. Then of course, there will be ample time for questions and answers. All right, so number one thing I expect everybody to know when we talk about company income tax is that it is a legitimate responsibility for individuals and incorporated entities or legal persons to play their various responsibilities. Among those responsibilities, one of them that is very, very critical is the payment of taxes, right? Whether you talk about an individual or we talk about an incorporated person or a legal person. So I think that in our previous class on tax, we have some talks around. We had some talks around taxes that are payable by persons, right? And that was when we talked about the payee, the PIT, who is responsible, who is liable, right? And the conclusion that was made then was that payee is primarily accruable to every individual, irrespective of your status, that actually earns a monthly income. But if an individual don't earn a monthly income, if an individual don't earn a monthly income, then such person may be subject to tax still on the Personal Income Tax Act law, but on a direct assessment basis. But on a direct assessment basis, right? And we had a number of talk around that. Today, all attention will be placed on incorporated entities. How do they pay their tax? But just like I said when I was looking at the various captions of what we'll be discussing today, basically we have businesses that can be registered or incorporated. So those that are registered, we call them sole proprietorship. We use the word business name registration. Partnership is not incorporated, but business name registered. What that means is that this entity cannot sue and be sued distinctively, right? It means there is no separation from the business between the business and its owners. So these categories of entities don't pay tax. Why? They are not recognized as a taxable person in our various tax laws, whether in the Personal Income Tax Act or the Company Income Tax Act or in the Petroleum Tax Act, or whichever one you call it, or even in the Value Added Tax Act, Stamp Duty Act. None of these persons are actually recognized as a taxable persons. So that is why if you have a sole proprietorship business, the business on its own is not expected to pay any form of tax. However, the owner of the business, which could be the sole proprietor itself, right, or in a partnership business, the partners themselves are liable, separately liable for taxes on the income they have earned as partners or as sole proprietors, but not on the income the business has made. So please, it's very important we have these clarifications, right? So for repetition purpose, company income tax is only accruable to entities that have incorporated status in whatsoever form, incorporated status. Some have those obligations to not only make the computation but also pay an explicit sum as the taxes, while some also have the responsibility of making those computations, but their tax rate is at 0%, right? We'll be talking about that as we go on. But with regards to with regards to entrepreneurs operating with sole proprietorship identity, or operating with a partnership identity, they are not liable. The businesses are not liable, right? But the owners are liable on the income they have individually earned, whether from the business or from other sources. But that is not to say that if you run a sole proprietorship business or you run a partnership business, even though we affirm that the law did not recognize them as taxable persons, but because they are allowed to operate businesses, they have certain tax agency responsibility. That doesn't mean they are paying tax. So if as a professional or even an incorporated entity, you render a service to a business name operating as a sole proprietor, before the company pays you your fee, right? It has a tax agency responsibility of deducting the withholding taxes, right? So all categories of business, whether they are incorporated or otherwise, they all place their various tax agency responsibilities. So they are agents for the charging and the remittance of value-added tax. They are agents for deductions and remittance of pay as you earn, payee. They are agents for deduction of various withholding tax based on the transactional terms, right? So please, we need to get this clear. But our concentration today is which and how do you ascertain CIT and who is liable? Sole proprietors are not liable, partnership business are not liable, but incorporated entities are liable. You will also agree with me that when you have incorporated entities, they are also in various forms, right? They can be limited, they can be unlimited, they can be limited by guarantee or in various other forms. So if you are limited or unlimited, right, it is still an incorporated entity and they are liable to taxes, right? Those ones that are limited by guarantee still have the CIT filing responsibility, but the tax rate applicable to them on their primary income is taxable at 0%. But where they make income outside their primary responsibilities, those income is applicable or liable to income tax at the prevailing or applicable rates. So we need to have this understanding. The second thing we need to do, or the understanding we need to have, is that for companies that have company income tax responsibility, it is expedient that their financial statements be prepared. Even though every organization operating within a defined territory should render their stewardship responsibility, financial stewardship responsibility, but it is more compelling on entities that operate under an incorporated status, not only to prepare their financial statements, but also to get it certified or audited. Now, in the course of doing this, according to IAS 1, the standard actually provides that when you want to prepare a financial statement, it gives specific components of these, of these financial statements. One of those components is what we call the statement of comprehensive income. And when we are preparing the statement of comprehensive income, right? There is a line item there which we call the profit before tax, right? Next to which is tax. Then after it is profit after tax. And how to ascertain the tax expense that should come after profit before tax is as defined by what we call IAS 12, income tax, right? According to IAS 12, it provides that components of this tax expense should be combination of these two items. One, it should be partly component of what we call the current tax, and the partly component of what we call the deferred tax. I believe everyone is here with me. I just want to be sure that I'm not alone. If truly you are here and you are listening alongside with my explanation, indicate yes on the chat box. If you can hear me very well and you understand all I've explained thus far, please indicate yes. Awesome. Awesome. All right. Francis says he missed the last explanation. You have to specify what exactly among this explanation you missed. Okay. So what I was trying to say is this. Awesome. So what I was trying to say is I don't just want to go into company income tax computation without we having foundational understanding of what gave rise to this genesis. So my explanation is that for incorporated entities, they are expected to preparing stewardship accounts. And in the attempt of preparing that stewardship account, IS1 actually specify what should be the components of that financial statement. One of those components is the statement of comprehensive income. And I said that when you are preparing the statement of comprehensive income, of course, we know that you have the revenue, cost of sales, gross profit, distribution cost, admin cost, finance cost, audit fee, and related expenses. Then you get to profit before tax. After which you have the tax expense, then profit after tax. And I said that our concentration today is how do we ascertain that tax expense? What standard talks about or give us guidance on how to ascertain the estimate of that tax expense? And it was agreed that the appropriate standard applicable on that is IAS 12, income tax. According to IAS 12, it says that anytime you are preparing your financial statements, and the company is liable to income tax in line with your local tax laws, right? You must ensure that your tax expense must be a combination of two things. One, current tax. Two, deferred tax. What is current tax? What is deferred tax? But in summary, IAS 12 says your tax expense in your income statement should combine the two, and how to compute the two, whether income tax or deferred tax, or whether the current tax or deferred tax must actually be in line with our tax laws in the country where you are operating from. So we'll be dedicating a different class among the outline of events or topical issues we outline or marked for this mentorship semester on deferred tax. We dedicate a sole day that will talk about deferred tax. What we are concentrating on today is current tax. Remember I said, according to IAS 12, there are two components of your tax expense. One is the current tax, the other is the deferred tax. Now, since our concentration today is the deferred tax, is the current tax, I mean to say, and we know that your current tax is exactly what we call your, according to our local tax law, comprises of a company income tax, education tax. Other composition will then be based on the regulatory guidelines applicable where that company is operating. If the company you are consulting for or your employer is operating within the financial sector, right, then NITDA will be applicable. But those are other subsidiary discussion we'll have after we must have had good understanding of how to doing the company income tax. So my point now is, for us to be able to ascertain or estimate our company income tax, there must be a profit. For this purpose, these profits can be classified into two. We have what we call accounting profits, and we have what we call the tax profits. Accounting profit is the profit you ascertain when you prepare your statement of comprehensive income. In fact, the profits are even three. There is what we call accounting profits. There is another we call tax profits, and the third one we call cash profits. The cash profit is what we use, is applicable when we are actually preparing what we call statement of cash flow, IAS 7. But that is not what we are talking about today. Accounting profit is a profit you ascertain when you are preparing your statement of comprehensive income, or your statement of profits or loss and other comprehensive income. The tax profit is the accounting profit that has been recomputed for tax purpose in line with our tax laws. We call that the tax profit. So whenever we say we are doing company income tax computation, what we are simply doing is representing the accounting profits that must have been prepared or ascertained in line with our various accounting standards and regulatory framework, but strictly applying the tax laws, the relevant tax laws, in representing these representing these profits for tax purpose is what we call tax profits. So if after recomputation, what you still have is a loss, then the company under question will not be liable to company income tax. At the same time, a company may have accounting profits, and after recomputation for tax purpose, it may not have tax profits, it may be loss, right? When that happens, what is the legal provisionings? Does it mean entirely that company will not be liable to tax at all? We'll get to know as we go on. So in summary, I believe everybody understood this, understand this preambles I've given to this before we go in depth. Please, if you are very much with me, I just want to be sure I'm not alone on this, indicate hi, and if you understand what has been explained thus far. All right, thank you for the feedback. So we say in practice, there are adjustments made to the accounting profit to enable the taxman arrive at a taxable profit. The accounting system is flexible and makes provision for most expenses, including personal expenditure, to be allowed for deduction before arriving at the accounting profit. Of course, just like I explained earlier on, the rules, the principles that guide how we present the various presentation when we are trying to ascertain the accounting profits accommodate various expenses which are not recognized within our relevant tax laws. Adia, do you have any question? You're raising your hand. Quickly make it open. Adia, do I take your raising your hand as an error? Otherwise, just make your point here. Okay, she says it's an error. All right, so examples. For example, depreciation is an allowable expenditure for accounting purpose. While in tax, we don't call it depreciation. We don't recognize depreciation. In lieu of depreciation, we give what we call capital allowance. The profits before tax in the statement of comprehensive income serve as a starting point for arriving at the adjusted profits for tax purpose. So what that means is that if you want to present profit, your company income tax computation, you must have been able to have well presented your statement of comprehensive incomes, right? Without which you will not be able to do anything. However, in a much more complex scenario, if somebody like me, if you don't prepare the statement of comprehensive income, but you give me the trial balance of that very company, I can still come up with what we call the computation of income tax, but those are advanced level. I believe those who are in practice here too, who have had that understanding, could also do same. Not all captured expenditure in the statements of comprehensive incomes are allowable for tax purpose. So all the incomes and expenses that you have reported in line with your various accounting standards and the applicable guidelines, regulatory guidelines in each sector, may not all be tenable for tax purpose. So if we say it may not be tenable for tax purpose, what then should be the law that we tax people or taxman or tax consultant should use when you are making your company income tax computations? I've said it that what makes a difference amongst various accountants, the knowledgeable ones and just those who are just doing what they are doing without knowing why they are doing what they are doing, is the knowledge of the frameworks. So which among all those frameworks are we paying attention today? We shall be paying attention to what we call the Company Income Tax Act. The latest addition to the Company Income Tax Act was actually made in 2021 via the Finance Act. But for you to know what changes has been made on this act per time, you need to understand, first of all, which particular year, tax year, does the financial statement you are computing the CIT on relate to. So even though we have the Finance Act of 2021 as we speak, and it is effective, if your consultations you are making to your clients is in respect of year 2000 financial year, please, you have to ensure that you use the applicable law effective in that year. My point is, Finance Act of 2019, 2020, and 2021 are not to be applied retrospectively outside those years that have been marked as their effective year. So for every one of us who have jettisoned the provisions or position of the sitter in the prior periods, bear it at the back of your mind that it doesn't work that way. You have to, even though changes have been made on those laws, but when you still have accounting issues relating to that particular period, you have to identify, first of all, what is the relevant financial year, what is the applicable tax year, and what is the tax law that are applicable to that very year in question. I believe that is clear too. So in the course of my explanation today, I'll be quoting various sections of the Company Income Tax Act. When we talk about expenses that are allowable and the ones that are not allowable, definitely Section 24 of the Company Income Tax Act make exclusive provisions around that. Are we together? So Section 24 actually talks about what are those expenses that are liable for tax purpose. So if you want to know which one is liable for tax purpose, you need to go and peruse Section 24. I believe that is clear. So deductions allowed is in Section 24 of the Company Income Tax Act. Donations, which we'll also talk about that are liable, is under Section 25 of the Company Income Tax Act. Research and development, which one of it is liable and which is not, we'll talk about that under Section 26 of the Company Income Tax Act. Deductions not allowed, that is in what we call Section 27 of the Company Income Tax Act. Waiver or refund of liability or expenses is under Section 28 of the Company Income Tax Act. And the one that talks about profits that are exempt or not taxable is as contained in Section 23 of the Company Income Tax Act. So you can see that the pillar to the success of a taxman is your good understanding of the various tax laws and the relevant sections that are applicable to what you are doing part-time. So please, I want to believe that in our first class in tax, the substantive law on the Company Income Tax Act has been shared with quite a number of us. Please, as we make this reference and as you make your revisions, make reference to all of these relevant tax sections and relate it with what explanation has been given for you to become a better you. So Section 24 of the Company Income Tax Act as amended states clearly that for any expenses to be liable for tax purpose, such expenses must be wholly, reasonably, necessarily, and exclusively incurred for the purpose of generating profit for the period. So let's explain what we mean by wholly, reasonably, necessarily, exclusively. We put this together using the W, R, N, and E. We call it REN, right? That is the acronym we've been able to make out of that. But what is it when we say something is wholly? What it means is that before you can claim that an expenses is deductible for tax purpose, wholly is referring to that expenses must be incurred solely for the purpose of the business. If the purpose of incurring it is partly for business purpose and partly for other purpose other than the business purpose, then you can't claim entirely all that you have incurred. That's the concept of wholly. Then reasonably, for an expenses to be recognized as a deductible expenses, it must actually pass the reasonability tests. Can you imagine if somebody says, oh, from Ikeja, the office is at Ikeja, and he or she is going to visiting a client on the island, the transportation from Ikeja to island is 150,000. It is not reasonable. So reasonability test is actually a personal judgment, but you have to look at it not with a selfish interest, but with ability to actually pass a common sense test. So that's what we mean by reasonable. The amount you are claiming to be deductible must actually pass that reasonability test. That is it logical for an expenses of that magnitude or that minute to have been incurred for that purpose? Then necessarily, what that means is that, is it possible we still continue with our business and achieve the same purpose without or possibly not incurring that a particular cost? If it is not very necessary, then the amounts that have been incurred and reported may be disallowed. Then exclusively, still emphasizing that it must actually be solely for that business purpose. All of it must be solely for that business purpose. So each time FIRS, being the relevant tax authority on company income tax affairs, want to conduct desk review assessments or even tax audits, they look at the various disclosures that have been made around expenses projected to have been reasonably incurred around these captions before they would say an expenses is actually allowable for tax purpose. It must pass the Holy test, it must pass the reasonability test, it must pass the necessity test, and it must pass the exclusiveness test. I believe that is well understood. Please, these are very relevant areas of what we do in practice, and I don't want to rush this at all, right? I want to be sure that we are going at a common and understandable pace as we go on. Please, if you understood what I've explained thus far, indicate yes. All right, thank you for the feedback. So we have taken time to going through that section 24 and make some extractions of expenses that can be reported as allowable expenses, right? For you to understand this more, please make reference to section 24 during your private study, right? One of those expenses that are recognized or will be recognized as allowable expenditure is any sum payable as interest on debt borrowed. So you know debt borrowing can be local or it can be foreign. What I mean by that is that you can borrow money, a Nigerian company can borrow money locally. And a Nigerian company or any entity operating in Nigeria can also source for loan from outside the country. That was why I asked the question on thin capitalization then, and somebody confirmed that it is a comparison between your debt instruments or your debt capital vis-a-vis your equity capital. You know that businesses are funded by two things. Either of the two things is either the owners of the business provide solely all that is required as capital, or they provide partly and source for debt or loan to complement their business needs. So when you borrow this money locally, the interest you pay on it, provided it is wholly reasonably, necessarily, and exclusively used for that business purpose, it will be reported as an allowable expense. This is why companies, very profitable companies, even though they have all the money required to funding their business processes, it is more economical and tax-wise for you to take loan to finance the business, because that interest that you will have incurred will reduce your tax exposure by the magnitude of those interests. But bear it in mind that you should pass the reasonability test. However, if the loan were actually obtained from a foreign country, right, then the concept of thin capitalization policy effective 2019 Finance Act is now more pronounced, right? There is what we call, maybe we could also, because of time, just dedicate another section for that, because we need to be talking about moratorium period. What do we mean by moratorium period? Who has an idea about what we mean by moratorium period? Moratorium period is applicable when you obtain a local loan or a foreign loan. But what is the meaning of moratorium? Over to everyone. Okay, go ahead, we can hear you.
Moratorium period is a period whereby the person that obtained the loan will not pay or will not make any payments for a particular period of time specified in the agreement of the loan.
Awesome. So the proportion of the interest that will be exempt effective from 2019 Finance Act, you need to check the third schedule of the Company Income Tax Act for that, actually talks about what portion or all of the portions of the interest per the moratorium period that has been adhered to, right? But when it is now, that moratorium period of a thing is, as stated in that third schedule, is actually applicable to foreign loans, not local loans. So if your client is entirely or has entirely obtained loan locally, and FRS is trying to apply the moratorium period, they are trying to apply the third schedule, trying to prorate portions of the interest expense that will be allowed and not allowed, that will not be applicable, because on all local loans, that third schedule is not applicable. It's only applicable on foreign loans. And why that particular submission was made effective 2019 Finance Act was because of what we call capital flight. What is the meaning of capital flight? Grace Danjuma, your contribution earlier is well recognized. Your position or your contribution on what a moratorium period is actually very correct. Thank you. But what is capital flight? What is capital flight? Anybody? Don't tell me nobody has an idea of what capital flight is.
Taking investable fund of one country to the other.
All right, that's very correct. So why in practice, the third schedule was actually reframed and reviewed was because a lot of companies structured their investable funds trying to take advantage of the loopholes in our local tax law with regards to the thin capitalization policy. Prior to 2019 Finance Act, we don't have anything, thin capitalization policy. That is, if you like, your debt capital can be 90% and your equity be 10%. The advantage of doing that is that for foreign investors, they will repatriate all the profit as much as possible through interest on those loans before the government is even aware. But with the effects and introduction of the Finance Act, amending our existing third schedule of the Company Income Tax Act, there is a standard rate or proportion of our thin capitalization rule that every company having imported debt instruments must adhere to. It is ratio what? Who has an idea? What is the ratio of our thin capitalization policy, the maximum, the minimum, no, the maximum I should say, that companies are expected to adhere to? Before now, there is no proportion. You can make it in any order. But effective 2019 Finance Act, there was a minimum or a cap that everyone must adhere to. It is ratio 70 to 30. That is, your capital can be or should not be less than 70% if you're having foreign debts. And your debt instrument must not be more than 30% if you are having foreign debt. If you like, and you choose to make it higher proportion, nobody will castigate you. But the proportion of the interests that will be recognized as allowable will now be controlled or amended by virtue of that relevant rates that have been provided. So that is the understanding I want you to have under any sum payable as interest on debt borrowed and the likes. Interest on debt borrowed is very allowable when it is 100% when it is locally obtained. But when it is foreign obtained, you need to look at the thin capitalization rule. You need to look at the year that we are looking, that is applicable in question. You need to look at the moratorium period and the period that the loan has been given before you can know what is the applicable or the proportion of the interest that will be recognized as a liable expense. So during company income tax audit, these are part of the sensitive areas that you should pay attention to. Then secondly, we have rent and premium in respect of land and building occupied for the purpose of the business or for the purpose of generating profits. If you have incurred rental expenses and the rent is entirely used for the business, or the business place is actually used for the business alone, then 100% it is allowable. But when it is not used for the business alone, you as the owner, you are living in part and you are actually using part for the business, then what the tax authority will only recognize as a liable expense will be, for this purpose, will be the one that relates to that of the business. Then specific provisions of bad and doubtful debt estimated to the satisfactions of the revenue that have become bad and doubtful. So this is actually very debatable because prior to the introduction of IFRS 9, IAS 37 actually talks about you making your provisions, and then we talk about general provisions and specific provisions. General provisions are those general caveats or blanket assumptions you make when you say, oh, you have made a sales of 100 million. From experience, maybe 30% of everything you sell has always been seen as not being recoverable. So that is a general provision. But when a particular customer gets or is in default and they could not pay, that is now specific. But you know that the rules and standard guiding financial reporting now has moved away from the provisions of IAS what do you call it, IS 37, and all those financial assets and financial liability are impaired, or provisions for impairments are made within the plight of the relevant provisions of IFRS 9. And depending on which sector the company is operating, which method are specified in IFRS 9 you are using. IFRS 9 is another very broad standard that can't even be completed in one class. Hello, mute. Amobade, please mute your mic. So that's also another very complex area. So we have seen in practice that this is highly subjective areas that it's very, 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 very debatable. But provided you have been able to have substantive evidence that the provisions you have made is not just general, but very specific, you can then treat and recognize that as a liable expenses. Otherwise, it will not pass that test. Then contributions to any approved provident or pensions or retirement scheme or fund. So the expenses you have incurred on your staff for pension provisions or contributions and the likes, they are also a liable expense. Repair and renewal costs relating to the premises, plants, fixtures used for the purpose of the business, provided it is not of capital nature, it is also liable. So it is important to note that only repairs that to maintain the earning capacity and not a major overhauling of such premises, plants, and fixtures are allowable. So next one is any expenditure incurred during the year with regards to salaries of employees and other senior employees. So every cost you incurred in that regard is also an allowable expenses. Dividend distribution made by real estate investment company approved by the Security and Exchange Commission, provided such dividend were redistributed to shareholders, is also allowable. Then donations made to any approved body or schemes as listed in the 5th schedule, the position of the law is that such donations should not exceed 10% of the total profit of the company. So when you are making company income tax computation and you saw donation as an expense, you have to first of all identify, check the 5th schedule to knowing who are those bodies that are approved. ICANN is there, a number of other religious organizations are there and all of that. You can check to confirm the schedules on the 5th schedule. If the donations are not made to entities that are enlisted on that 5th schedule, then what you have incurred as donation expenses will be disallowed. Then even if you have make donations to those people or entities as contained in the 5th schedule, the actual donation you have made should not exceed 10% of your total profits, excess of which will not be what? Allowable. So these are understanding you need to have for you to be able to perfectly and correctly make company income tax computations. Finally, the Finance Act 2020 makes provision for any donations for the purpose of COVID to any approved state or federal government body to be allowable for tax purpose, but it is subject to the approval of the Minister of Finance. Furthermore, any company that procures items to be donated for purpose of COVID-19 shall be allowed such sum as allowable expenditure, provided evidence of such procurement will be provided on request. This is also subject to the approval of the actual amount you have incurred, is subject to the approval of the Minister of Finance. The Finance Act of 2020 states that donation for COVID-19 purpose shall not exceed 10% of the accessible profits after considering other allowable deductions. So this is very, very critical. You need to arm yourself or equip yourself with this understanding as opposed to general public perception about how company income tax should be done. Section 25 of the Company Income Tax Act, as amended, also make provisions for donations, whether of capital nature or not, to tertiary institutions for the purpose of research and development, to be allowable for deductions for tax purpose. However, the amounts to be allowable for tax purpose shall not exceed 15% of the total profit of the company or 25% of the tax payable for the year of assessment, whichever one is higher. So if you want to make donations to tertiary institutions for research purpose, and even if what you are contributing is for a capital, is of a capital nature, you should make those your disbursements paying attention to those limits as provided in Section 25. Otherwise, the excess of your donations that is above the higher of the 15% of the total profits or 25% of the tax payable will then be disallowed. I believe this is very clear. I want to be sure that I'm not alone. If you are still with me and you understand all that we have explained thus far, please indicate hi. All right. So donations are expected to pass the following tests and conditions before it can be allowed for tax purposes. Donation must be made out of profits. So if that earlier caveat that they have given to us, you have exceeded it, then it means you are not making a donation out of profits. Any company that makes laws in a year of assessment and makes donation cannot make claim for such deductions to be allowable for tax purposes. You can't be at the loss state and be claiming that you are making donation. Donation should be out of profits, not out of your revenue. Donation should not be capital in nature. I think I've explained that one before. Donation should be made to approved bodies as listed in the 5th schedule. I think I've explained that one too before. Donation should not exceed 10% of the total profits of the company before making such distributions or donation. Very important. I think I've also explained that before. Then those entities that may be, that you could make those donations to, I've made some of the extractions here. Youth or philanthropic organizations such as the Boys Brigade of Nigeria, if you make donations to them, it is allowable. The Nigerian Red Cross Society, if you make donations to them, it is allowable. The Girls Guide of Nigeria, if you make donations to them, it's allowable. The National Youth Council of Nigeria, if you make donations to them, it's allowable. The Boy Scouts of Nigeria, the National Youth Trust, if you make donations to them, is allowable. Religious organizations such as the Christian Council of Nigeria, the Islamic Education Trust, please, you notice that there is no specific church that is specified there. So if you donate to churches, it may not be allowable, except the name of the church is specifically stated on this 5th schedule. If you make donation to any mosques, it's not allowable, except it is for Islamic Education Trusts, right? Then any hospital owned by the government of the federation, the state, or university hospital not set up for the purpose of profit or gain. So if you make a donation to any private hospital, it is not liable, except their name is specifically mentioned in the fifth schedule. And if you have clients whose name are not currently mentioned and you think that because of the nature of what they do, they should be beneficiary of this exemption, because if they are then enlisted, entities will not be willing to making donations to them. FRS has made a caveat, a publication that you can actually get registered for your name of your organization to be enlisted on the fifth schedule. If you need consultation on that, we can be of help. We can be of help. So no, the above list does not cover all approved bodies. Audience to visit the fifth schedule of the CITA and get your knowledge enriched. Then the ordinary rule, this now talking about the disallowable expenditure, which expenditure, we've talked about the ones that are allowable. Of course, there are portions that also talks about the non-allowable expenditure. Please bear in mind that when you pick the audited account of any company and you want to make tax computation, these are things that you should bear in mind. You should read the audited account from the beginning to the end, because other relevant disclosures that are made in the account could give you one insightful understanding of the other. My experience has shown that people, when they want to make computations of tax for tax purpose, they just concentrate on the part of the account that they make disclosures, presentations for figures. Please, it should not be. Presentations or disclosures other than figurative ones could also be very insightful, telling you more about the underlying assumptions of the various expenses incurred. Timothy, please mute your mic. So the ordinary rule in commercial accounting for the purpose of arriving at the net profit for the period is usually flexible and accommodates all expenditure, including those not only reasonably, necessarily, and exclusively incurred for the purpose of generating the profit. So I think I've also explained this before, that our rules and accounting standard recognizes certain things that are not tenable within the tax, relevant tax laws. So it is important that we should be able to pinpoint on this and make necessary adjustments when and where applicable. So the disallowable expenditure for tax purpose are expenditures of capital nature, you purchase assets and the likes, as contained in IAS 16. It should not be recognized as an allowable expense, but rather disallowed. But in lieu of the disallowance, the capital allowance on qualifying capital expenditure could then be claimed. Then any sum recoverable under a contract of insurance or indemnity. You have taken an insurance policy and let's say the company suffered a loss, and that recovery that you made under it is not an allowable expenditure. So take note of that. Or the income you also make, the compensation you have from the insurance policy after having suffered the loss is not a taxable income. Payments for any unapproved pension. So if the pension contributions that you are making is not approved, that is, you are making voluntary contributions above the caveat or provisions in the Pension Reform Act, it will not be recognized as allowable. Depreciation of any asset is not allowable. In lieu of that, we have capital allowance. General provision for bad and doubtful debt is not allowable. I told you that you need to convince the tax authority beyond reasonable doubt that that provision you have made is specific. Then I will encourage each and every of us to go and study very well IFRS 9, because most provisionings now are done in line with IFRS 9 and IAS 36, impairment of assets, right? So you need to be able to actually justify that these assets that have been impaired and provisions made actually physically suffered that loss. Otherwise, it will not be recognized. Any preliminary and formation expenses, expenses on issue or redemption of shares and other securities is not allowable. So for those of you that prepares financial statements and you report exclusively the preliminary expenses or formation expenses, the corporation costs and the likes, it is not an allowable expenses. So you need to be able to check within the ambit of the relevant accounting standard and see a more suitable nomenclature that could be given to it. Any expenses incurred in deriving income exempt from tax is also not allowable. So I made mention of, if you have a client that wants to be enlisted on the 5th schedule, Please indicate, can you see my screen? I'm so sorry, there was disruption here. It's raining a bit heavily. Confirm if you can see my screen and if you can hear me.
Loud and clear.
So we were talking about the disallowable expenses, and I've made mention of quite a number of them. Loss on disposal, any expenses allowable under the deduction of capital gain tax act is also disallowed here. Then any penalty imposed by any act of the National Assembly, if you incur any fines and penalty, it's not an allowable expense, it's disallowed. Any tax or penalty borne by a company, the amount you paid as tax, you can't claim it as an allowable expense. Then waiver and refund of liability and expenses. In circumstances where the liability of an allowable expenditure with respect to Section 24 of CETA as amended is refunded or waived to the company, the position of the law is that the amount of such liability or expenditure waived should be added to the company income tax for that year for the is that if you have incurred an expenses and that is subsequently waived, that means that it will have an impact on your CIT provisions. So you have to add and increase your taxable liability, taxable profits to the extent of that waiver. In arriving at the accounting profit, all incomes, whether from the company's corporation or incidental income, are shown in the statement of comprehensive income. However, for tax purpose, not all incomes are allowable or taxable, and not all expenditure are also allowable. So for you to know more about what is a portion of those incomes or profits that are not taxable, see section 23. Then on interest on debt from foreign companies, I believe I've explained this one too earlier on when I talked about thin capitalization rule, the rule of effective 2019. Before 2019, we don't have any thin capitalization rule in Nigeria. So you can choose to structure your debt to equity in any proportion. But effective 2019, the rule is 70 to 30. Your equity should be 70% and your debt should be, it could be less than that, but it cannot be more than 30%. So that rule is also explained here, and it further emphasized that not all the interest that you have suffered on it will be allowable. It should have to be the allowability of the interest will be a function of the provisions in the 5th schedule as in line with the relevant provisions of the Finance Act effective 2019. So this gives us an insight of how the template for the computation of company income tax will look like. You have to first of all adjust your profit, identify your profit before tax or your loss before tax, add back to it all disallowable expenses. Then less from it all non-taxable incomes that have been included in the profit before tax to get your adjusted profit. So this is a specimen. Because of time, we will share the slides, but more importantly, I will share with you in our next class a much more robust template for the benefit of those who are not working in regular audit firms, but want to assist their employer in being able to make the right computation of company income tax. I'll share this slide with you. But in this one, if you had to look through it, gross profit is 7 million, other incomes is 3 million, salaries and wages is 500,000, rent and rates is 300, depreciation it's 100, electricity is 70, repairs and renewal is 400, finance cost is 50, bad and doubtful debt is 100, donation is 1 million. So then you have loss on disposal of fixed assets is 350, net profit is 6.9. So for this kind of question, you need to be able to review each of the components of this question, particularly the other income. Review it in line with section 23, whether all the relevant components of this are actually taxable, right? Otherwise, it will be deducted. They review all the expenses here, whether they pass that REN test, and they qualify as expenses to be recognized as allowable in line with section 24, right? Then in line with section 25, you also look at the provisions of donations and the likes to be sure that we actually met, the disclosure actually met the minimum threshold. Additional information in this question, they said, bad and doubtful debt consists of general provisions 70, specific is 30. What is the portion that will be recognized as allowable, and what is the portion that will be disallowed in this general, in this bad and doubtful debts? Who has an idea? Allowed is 30, Danjuma, correct?
That is specific one will be recognized.
So you know this, which one are you making adjustment for now?
What we are making adjustment for is specific one will be the one that is recognized. Why
is the general?
Exactly. My point is everything has been deducted before. So the one you are making adjustment for is the general. Very correct, right? So what you will add back is they have deducted 100 before. What you will add back is 70. Then I said other incomes was derived from the profit on disposal of fixed assets. What do we do to this? What do we do to?
We subtract, we adjust.
All right, because profit on disposal of fixed asset according to section 23 of CITA is not a taxable profit. So it should be deducted. It has been added before. We deduct it. Normally, accounting standard expects us that this is recognize this particular sum as an income, but for tax purpose, it is not tenable. Repairs and renewal was on a newly acquired plant which got faulty before it was ready for use. What is the position of this? Will this be allowable? Will number 3 be allowable? It will be disallowed correctly because one of the conditions for claiming capital allowance is it must be put to use, right? So it doesn't pass the test for rent purpose as expected in section 24, and it doesn't also pass the test for we have to look at it in a plus whether it actually pass the test for qualifying capital expenditure. Donations was to the federal government to provide vaccination for victims of COVID-19. Will that pass the test for deduction? Will that pass the test for deduction? Yes, but you have to look at the caveats there. How much was the donation? 1 million. You have to look at the threshold that has been given. If you go back to that slide, when we talk about the allowability of donations, right? I want everybody to be on the same page. Donation shall not exceed 10% of the total profit of the company before making such donation. So you need to check to be sure that that provision has not been breached. And when it is in respect of donation for COVID purpose, it must be subject to the approval of the Minister of Finance. And there are two other caveats that has been given. So you must be able to test it within the plight of those provisions, otherwise you will have to make adjustments. Please take note. Then the accountant omitted allowable expenses amounting to 450,000 while reporting the account. What adjustment will be made to this? Will it be deducted?
To be subtracted since it's allowable.
Exactly. So it has been omitted in their financial reporting purpose, but tax law is very magnanimous. It doesn't want to be cheated, and you too must not cheat the government. So when you have incurred legitimate expenses that is allowable in line with the relevant sections of the law, then it will be recognized. So please, we have made this extraction because of the mode of the training. Had it been in a physical session, we'll have been able to see some of these practical scenarios on your own. But it's very simple and easy to apply. From today, I will expect that the accounts, if you have not been the one doing the tax computations in your company, pick the financials, do the tax computations, read through every disclosures therein to know and test whether the income disclosed is actually pass the recognition test to be subject to tax, and the ones that don't pass the recognition test, the taxability test, you made adjustments accordingly. I will also encourage you to peruse very well the what we call the CITA itself. Familiarize yourself very well with the relevant provision as far as company income tax computation is concerned. You should be very familiar with section 23 to section 40. It is very relevant and applicable to company income tax computation. So, any question? This is what we have earlier explained, the computations, right? This slide will be shared with you just like I explained earlier on, and you can make better input. But for you to have more insightful contributions or learning or hands-on on practical scenarios, please, I will encourage you to peruse very well accounts of your company. Even if you are not the one doing the computations, you can look at what they have done, ask questions for clarifications. If it's something you need further clarification on, put it on the group for discussion, or just private chat me. We can reach a better consensus together. Before we take more practical scenarios, you observe that we limited this to computation of adjusted profit today. There is another very salient area relating to computation of capital allowance. You have to take that very topic also before we can then solve a comprehensive practical questions that will embed the two, that is the computation of adjusted profit and even extending to the total profit as the case may be. So this is where we're going to draw the curtain today. But before we round it all up, I will expect that each and everyone that has relevant areas for clarification quickly bring it up, and let's trash it out together. Please, question everyone. I believe you have had something more insightful to what you have known about this before now. Is there any area among what we have explained before that you don't understand? Danjuma asks that what is the difference between adjusted profit and accessible profit? Honestly, unfortunately, within our tax law, there is no distinct clarity. However, that is why when you want to claim, you want to compute education tax, right? Some people make it 2% of the adjusted profit because the tax law did not actually specifically mention adjusted profit. But in practice, and it differs, the custom differs from companies to company. Some companies make the adjustments you make, final figure you got sections of the tax law. But when you then deduct loss relief from it, what you would then have is accessible profit. But technically, they are actually the same thing. Those who make differences between them are actually doing that, so managing the exposure of their clients with respect to education tax. I hope that answers your question.
Good evening, sir.
Jima, I don't get your question very well. Can you enable your mic and quickly ask?
Hello, good evening, sir.
Yeah, good evening.
Yeah, I'm Victor from Cross River. I want to ask a question.
Go ahead, please.
So, like other company now, let me say, like Zenith Bank, since it's said in a partnership company, they are not liable to pay tax. Like the company is not liable to pay tax. The individuals pay that tax themselves. I want to ask, like in other company that they do ask people to invest on, when they want to provide, when they want to write a financial statement, they increase the profit to the public so that public can come and buy shares and involve in the company. So now, if the financial statement of a company is being tempered, it's been increased for profit purpose, how do you assess them in that tax?
I don't want to believe that any person or company will play with the figures of their profits. I'm just being very professional here. But where such is being, because if whoever that is auditing the account, we have actually attested to the correctness of disclosures made therein. But in subjecting any company to tax, we have to strictly follow what we have done here today, if it is an incorporated entity. But if they are individuals, we have also said it that individuals don't pay company income tax, right? They are subject to tax based on the Personal Income Tax Act. And that, I think we discussed something relating to that in our last class. Does that answer your question, please?
Yes, sir.
All right. Any other question, please?
Good evening, sir.
Good evening.
Okay, my question was, when a company borrows loan from international institution and at the point of repayment, do you deduct withholding tax on the loan repayment, both on the interest and the principal? And also, do you charge VAT on both the
Please
principal
make it
and the
clear.
interest?
Repeat it again. I want to be sure I get your question.
Okay, a company borrows loan from a financial institution abroad. So, and they are
Okay.
repaying the loan. So, do you deduct withholding tax on the repayments and VAT as well, on both the repayment and the interest?
Okay, so first of all, on the VAT affair is actually governed by the Value Added Tax Act. And from all decided cases, VAT, interest is not valid as a supply of goods and services. Therefore, it is not a taxable income. So where somebody has taken a loan from a foreign entity and is paying interest on it, VAT is not applicable. You will also bear me witness that when local banks, when you take loan from them and they are charging you, they are not charging VAT on the interest. Rather, the management fee that is being, that accrues on that service when you are just trying to formulate the agreement of that loan, that one management fee qualifies as a supply of service, right? Management fee will attract VAT, but interest anywhere will not attract VAT, whether local or internationally. Then on the second one, whether the concept of withholding tax is applicable. Applicability of withholding tax is a function of who owns the fund. You will observe that when you are having a loan repayable to a bank, the bank is in custody of the money. Whether they are the one paying you interest or you are the one paying them the interest, they are in custody of the money, right? So that is why when they are to pay you interest, they will deduct withholding tax. Is that clear? But in application to your question, if it is not a financial institution, it means you will be in custody of, you have full control of the fund. So before you pay them the interest, you have to deduct withholding tax. But the rate of the withholding tax you will deduct will be a function of where is the company that gave you the loan. Do they have double taxation agreement with Nigeria? If they don't have double taxation agreement with Nigeria, then the loan, the interest will attract withholding tax at 10%. But if they had withholding tax, if they had double taxation agreement with Nigeria, then the rates could differ based on the agreement or the treaty Nigeria has with that country. So I believe that is clear. But in a nutshell, anything interest is not vatable. You cannot apply VAT on interest. But withholding tax, withholding tax applies on interest. But whether you will then charge it or not is a function of, are you in control of the money? If that foreign company, you bank with them, they will not need you to authorize the payment before they withdraw, they make adjustments on your account. In that wise, you will not be able to deduct withholding tax. But if they are not a banking institution, you are in custody of the money, you are to determine when you will pay them, then of course you have the right to deducting withholding tax. I hope that is clear.
Yes, it is. Thank you so much, sir.
All right, any other question?
Good evening, sir. Good evening, sir.
Yeah, good evening, Bobo. Your voice is very faint. Speak louder.
Okay. Good evening. Can you hear me now?
Okay, I think it's better.
Okay. So I want to ask a question relating to real estate. So
Relating to
real estate.
okay, go
The
ahead.
company engaged in a real estate. Okay. The question is like, we are allowed to, we are exempted from charging VAT from our clients, right? Then what about our supply vendors charging us VAT? How are we going to sort this one out? Because I know from experience that we normally sort it out by input and output VAT. So how is this going to be treated?
Okay, so first of all, the ability for you, the procedure for you to claiming your input VAT is a function of what is the transaction that gave rise to the input VAT you have actually incurred. And the provisions in Value Added Tax Act is very clear. If you have incurred VAT on fixed assets, the law says you cannot claim input on assets. So what you need to do is to capitalize that VAT as part of the cost of that very asset and be claiming capital allowance on it. And I'm sure if you check IAS 16, IAS 16 also provides that every cost incidental to acquisition of an asset and putting it into a useful economic state should be capitalized. That is one. Two, if you have incurred the VAT on OPEX, right? The law is actually very clear too. Any VAT incurred on OPEX cannot be reclaimed. Is that clear? So what the law allows you to do is that cannot be reclaimed as input VAT, but they expect you to write it off as part of the cost of your expenses. Say, for example, auditors audited your account. When they are sending their fee is 1 million. Then they charge VAT at 7.5%. That is 1,075,000. So what you should report as your audit fee is 1,075,000. Is that clear? So you need to put clarity to that your question, whether on what area of VAT or operation do you incur VAT on to know how best to addressing it. Except you are saying that what I've explained addresses your question.
Yeah, it actually addresses it in two ways, because for the operating expenses, OPEX that we are talking about, we actually incur VAT also from there, and you also incur VAT from a contract.
What sort of contracts now?
Like either service contract or construction contract.
Of course, so most of those ones will be included if you have, okay, I think I get what you're trying to say now. If you, as a real estate company, if you have some lands that have been outsourced to a contractor to build, and they charge you VAT in it, that VAT will form part of the costs of that inventory, because the land, I mean, the buildings to you will be inventories. It's not PPE, right? So you will include it as part of the costs, because you cannot actually charge VAT on land, on sales of land. Sales of land does not also qualify as a VATable income, right? So that should be the appropriate thing you should do.
Okay, thank you.
Yeah. Any other question? Any other question, please? Okay, so the only other question we are seeing here relates to what we discussed last week from Danjuma, where I said I would give you a feedback on the relevant area that gives the tax authority the opportunity to conduct investigation indefinitely. you definitely we need to look at section 65 and 66 of the Company Income Tax Act. So what they use there is not conviction, but provided that any form of fraud, willful default, or neglect has been committed by or on behalf of a company in connection with the tax imposed under this act. So that was what I was trying to explain in last week, that the tax authority should be able to establish the fact that you have committed a fraud. And really and honestly, the position of the tax law and the intent of the law is very clear. They don't have that interpretation right. It is the courts that can only convict you when you have committed a fraud or willful default. Even if EFCC arrests somebody as a suspect, they will still be taken to court, and the court will give the conviction before they can then melt out the necessary disciplinary action. So where the tax authority wants to act in contravention to what the intent of section 66 has said, that you could only do audits within a period of 6 years. If you want to go beyond that 6 years, you should actually provide that there is a basis, an established case of fraud that have been committed, willful default that have been committed, or neglect that have been committed on the premise on which you want to go beyond the regular 6 years. So check section 65 and 66, it puts more light on that. Danjuma, I believe that answers your question. Danjuma, are you there, or has it gone?
Hello, sir. I'm there, sir.
Okay.
Yes, sir. Only that I see in the FRS Establishment Act, section 35 and section 47.
Okay.
Expressly give FRS power to conduct tax investigation.
Yes, I'm not saying that they don't have the right. They have the right to conduct tax investigation. Yes, nobody is disputing that. But the condition for conducting that investigation must have been that the taxpayer must have committed a fraud. Do you understand?
Yes,
because
sir.
The tax authority is operating within the executive arm of the government. If a police arrested somebody as a thief today, within the position of the law, within the eyes of the law, he is not a culprit, but a suspect, until when he or she has been convicted. So what we are saying is that there must be that conviction. Who has the power to convict? It is not FIRS. You agree that anybody FIRS speaks, if the law has given them that power, because they are looking for money, they will always tell you, man, you are guilty. But the intent of the law, one of the canon of taxation is fairness.
Yes, sir.
Will you say somebody should be the tax administrator and also have the power to convict who has committed a crime or not?
No, sir.
So it will be putting too much power on the on the tax authority, and thereby abusing the legal process.
Okay, sir.
So that is my position, that there should be an evidence of that committance. And it is only after you have been convicted in court that they can now say, oh, I'm not saying in practice they are not doing it, but people allows them to do it because of this ignorance. That's my position.
Okay.
Yeah.
Thank you, sir.
Yeah. Thank you too. Any other question, please? Any other question? All right, so in the absence of any question, I believe we've been able to add little value additions to what you have already understood about this concept today. Danjuma, thank you very much. I like your insightful contribution with regards to the relevant provisions of the FRX Establishment Act. It shows that you are taking time to revise what we have done and also make some other discoveries. Please, I will encourage each and everybody to follow the same suits. Don't just keep all these materials in your system or in your archive. It doesn't add value, right? It will only add value if you have actually taken time to study them and when applicable, apply them in your work. And please do us proud. When next you go for an interview or you're in service to your clients, speak like a professional accountant that knows why he or she is doing what he or she is doing. Don't just say, oh, this thing is done this way. If they ask you why, you must, things you don't know the reason, ask your friend or make personal discovery on your own on what actually premise everything we do. Everything we do in practice is actually corroborated with one guidelines, with one submissions, or with one law or the other. I wish you all the best, but please also do us proud. Any of the updates about the firm that we put on this platform, please share it to as many persons, colleagues on various social media platforms as much as possible. That is the only thing you can do to paying us back for what we are doing for you. Also follow us on all our social media handles as much as possible before the end of the year. We want to put the name KCP in the mouth and the minds of at least 5,000 accountants. And with you, we can achieve that before the end of the year. I wish you all the very best and hope to see you once again tomorrow to compensate for those sessions we missed on Saturday and Sunday. Thank you very much for your time. It's well appreciated. Tell more about us to as many colleagues and friends of yours. And should you have any reason to be on how we can be of service to you, please do not hesitate to reach out to us. If you have clients you want to refer to us, or maybe for those who are in the industry, your clients needs, your employer needs a tax consultant or auditor, please will be glad to be of service. Or even if you are working in a regular firm or in a regular company and your company requires training of your finance team, please we do this too. We'll be glad to be of help. Thank you very much and enjoy the rest of the holiday. Thank you. Good night.